Hey, what's up, guys? So I know I've been out of the picture for a bit. It's just been a lot of events going on in the markets. So I've been doing some trading and investing. And I got interested in looking at some of these different companies and how their performance over the past year-to-date returns. And I've noticed there's been a lot of talk about debt-related companies and illiquidity issues in the bond markets, and a lot of concerned about certain companies won't be able to continue on with their debt payments. So I wanted to look into that, investigate the relationship between, or look at how what is the performance of high debt companies versus low debt companies year to date. So to do that, I had to pull some data. So where I pulled this data is I checked out FinViz, and so FinViz has a screener where you can just pull their data. You need an elite account where it's only about $30 to pull all the data, but you can pull some of their sample data. It's not a big deal. So I've already done that. So it's not a big deal. You could just do that, and I imported it into Python. So here you can see I've just imported pandas and NumPy, and I'm using this read CSV library in pandas to pull this CSV file that I've imported or exported from FinViz. And these are the columns that I'm looking at. And so if you've seen some of my other videos, this is the type of data I've worked with before. So we have the ticker, the company, we have sector, industry, earnings per share. What we're interested in today is we're looking at this total debt to equity ratio here. And I believe this is data as of the fourth quarter, Q4 of 2019. So we're hopefully not having any biased data here or forward-looking biased data. So what I'm going to do is I want to look at, I just want to segment and look at the high debt companies, so basically a ratio of greater than 1, and low debt companies, so a total debt to equity ratio less than 1. And I want to see statistically, is there a mean difference between those year-to-date returns. So you notice there's also a year-to-date return column data point here. Where is that? Performance year-to-date. So that's what we're going to be looking at. So you notice there's about 7,744 companies in this data set. So let's first state our known alternative hypothesis. And so high debted companies, and let's correct this here. High debted company year-to-date returns equal low debted company year-to-date returns. That's our null hypothesis. So we could state it formally like so, equals 0. And high debted company year-to-date returns do not equal low debted company year-to-date returns. That would be our alternative hypothesis. This is what we're interested in. We're hypothesizing, our alternative hypothesis is that there is a difference between the year-to-date performance of these different types of companies with high debt or low debt. So again, we can state our test statistic and probability distribution. We're going to assume normally distributed returns. We're also going to assume that the variances are equal, which is a major assumption, and you'll notice later that that may not be true. And so we'll continue with that. I'm not going to go too much in the math. If you're interested in the math, you can see one of my other video series where I do go into the math more specifically. So what I've done here is we've stated our test statistic here. And what I'm going to do is I'm going to take our data frame. So remember, we created a data frame here from our read CSV library. It's called DF. And I'm going to look at the total debt to equity ratio greater than 1. I'm also going to exclude financials because financials usually have high debt in general, and that may skew the data. I also don't want to skew the data by looking at companies that have a price less than $5. So you can look at the data how you want, but that's what I'm specifically going to look at. So just so that we don't have any weird outliers. So that gives us a sample set of 584 companies that have total debt to equities to ratios greater than 1, and we have 1,584 companies with total debt to equity ratios less than 1. So now we can pool our degrees of freedom. So we have about 2,166. Again, if you're interested in the math, look at one of my other video series on this. We need to specify our decision rule. So I'm going to assume 5% alpha. So that's going to give us a 1.96 decision rule. So we can reject the null if our t-statistic is larger than this 1.96 number, okay? Now we can actually collect the data. So I always want to state this. It's a lot of people just pull the data and they they have no hypothesis, they have no theory. So it's very important to have a theory or a hypothesis before you start pulling the data to avoid any data mining. So now we can do our data, quote unquote, mining. And before we do that, you'll notice when you do pull this data, this performance year-to-date number is a string in string format. We need to convert it into a numerical value, into an integer. So I've used this apply function where I use, for every value of x, I take that x value, convert to a string, it's already a string, and then I remove the percentage formatting and I convert it back to a float or an integer and divide by 100. So then you can see now we have 0.3630 because prior to this it was 0.363% as a string. So we've converted that. That's just some cleaning up data that we've done here. Next, we have to actually specify the data sets. So like again, I'm taking the total debt to equity ratio greater than 1. I exclude the financials, not equal to financials, and I make sure the price is greater than 5. So we have a high debt data frame and we have a low debt data frame. Same thing here, less than 1. And so that's good. So we can look at a year-to-date number here, you look at this column here, and we can look at the low debt data frame year-to-date column here. We can also create a histogram. And of course, before you continue with this, all this data will be available. You'll be able to pull it off my GitHub. So we can see a histogram here, if we just want to visualize this, of our high debt companies and a histogram of our low debt companies. And it's not really that intuitive, and that's why it's better, it's always more intuitive to actually look at the math at the end and the t-statistics. So, graphs are great and charts are awesome, but in reality, it can be very misleading by just looking at a chart. So we have this, and already we can kind of see there's probably some large variance differences here. And so we made the assumption that the variance of the two populations, sample populations, are different. Are equal, but it may be that they actually have very different variances. So we have to use a different test, and I'll show that quickly at the end. So again, we take their high debt data frame and find the mean. We'll find the mean of the low debt, and already you can see it looks like the high debt companies do have had a greater a worse year-to-date return versus the low debt companies of 30%, negative 30%. So we need to test that. We also pulled the variance of both, and now we can actually see there is a large difference between both of them. And so you can take these numbers and you can just plug it into this formula and you'll get your t-statistic. Or a very quick way to do this is you just can import from SciPy, import stats. And again, remember that's our decision rule. So this is going to be very important, 1.96. And once we imported stats, we can say stats.ttest.independent because we're assuming independent observations, populations, and we can plug in the data. Our equivariance is equal to true. Nano policy omit means removing any non-number values in there. And we get a t-statistic of negative 3.53, which is larger than our decision rule 1.96. So we can reject the null that, remember, our null is high debted company year-to-date returns equal low debted company year-to-date returns. So it does seem that we can accept our alternative hypothesis that high debt companies do not equal low debt company year-to-date returns. So there is a large difference here. So I thought that was very interesting. Again, remember we saw that the variance is very different, so we could use some different formulas in math, but we can also just use our stats model and just change this argument to false. And again, we still have a very large t-statistic, and our p-value is less than 0.05. So what's the intuition, and what can we imply from this data, from these results? So it does seem that high debt companies did perform worse than low debt companies in this year-to-date time period. This does not mean this will continue into the future. It's just an interesting observation. I would imagine that some of these high debt companies, there are still some value plays in there. Maybe they shouldn't have been sold so much. But I also would imagine that there's many of these low debt companies here that they got hurt, but there may be some value in there. So going forward, I'm going to look at high debt and low debt, and we're going to see what companies can we imply or look forward and think could do better in this next economic environment or regime that we're going to go into. So if you like this video, please subscribe. Till next time, guys. Thank you.